Welcome to the Broken Pie Chart Podcast, episode number 19. I'm your host, Derek Moore, and today we're going to be talking about this whole concentrated position. What is it? What does it mean? And why are people so reticent to get rid of, positions when they only have a few stocks or a single stock, even knowing that the risk is so high of doing so? And so, without further ado, what's a concentrated position? Many advisors face this, and many individuals face this. And a concentrated position is when you think about an account or collection of accounts for an individual or a household, where most of the assets are tied up in one single stock or, concentrated in a few different types of investments. And whenever you have concentration in one stock, that really does not allow for proper diversification. And of course, the way that I advocate for, there's some challenges with the diversification, and I talked about those in a previous podcast. Of course, I'll link to that. But when you think about money that's concentrated in one stock, you have to think about how risk is sort of looked at. And so, typically when you have money in one investment, you have money in a stock, there is single stock risk, meaning the company can have some really bad news. It could, you could see the CEO be let off in handcuffs. That's never good. Maybe a product or something that's coming out doesn't have good news, or maybe it's just earnings. The earnings that the company is reporting or earnings guidance going forward. Whenever investments are concentrated into a single stock or a single issue or investment, really there's any number of things that can cause drag or cause a stock to go up or down. And so the old adage with diversification, it's the whole, don't put all your eggs in one basket. I guess you want to carry a lot of baskets, right? Because if you drop a basket, it only has one egg, or if you have many baskets, I think that's where it came from. But, the idea is that if you have many different stocks in a portfolio, you can diversify away from what's called single stock risk. And therefore, if one company has bad news or something bad happens, you've got all these other issues that help diversify it away. Of course, what you can't diversify away, generally using traditional asset allocation, is systematic market risk, something like 1998 or more recently 2008, the Great Recession or Great almost Depression, as many people call it, where the whole market came down and it didn't matter really what you owned. It just whether it's different sectors, different countries, everything sort of went down. And so there's single stock risk, which generally is thought to have the ability to be diversified away. And then there's also that systematic market risk. And so a concentrated position is just where you've got, maybe it's a single stock, maybe it's a few stocks, but a lot of money is held up in just a few areas. And whenever that happens, the risk is pretty high. Now you might think most people, or the concept of diversification is probably understood fairly well by most investors. And you might say, well, how is it possible that if people know that you should have all your money into one investment or something like that, how do people acquire those? Well, there's a couple ways. The case that we see a lot of is, let's say someone worked at a company for many years, and as part of their compensation, they received grants of company stock, and they just accumulated a lot of, let's say they had options, stock options, or they had, and not options the way that we use them, but stock options where they're granted X number of shares at a certain price and they have the ability to convert into shares, or they're just granted shares as part of their compensation, or maybe as part of retirement. They received shares. And a lot of executives have company stock as part of their compensation. And so that might have been acquired over many years. And you think, somebody's been in a company, they're getting this stock, and maybe it's very, very low cost basis. We'll talk about, that's one of the challenges of selling. But a lot of times it's people who have simply been at a company for a number of years. The other reason why people accumulate a lot of one position is maybe they bought a company a long time ago when it was lower in price and they just held on to it, or when they were younger, they put a lot of money into a single stock and it sort of, went up, and they've got this low cost basis. And so Really the thing you see a lot of too is people have the same stocks. They've had them for many years. And so by having them for so long, and the markets generally go up over time, especially if you had stocks prior to that great bull run of 1982 to 1999. And of course, post 2001, market went up again. But that's a case where you may have very, very low basis and you might have just a couple different shares. People forget that, mutual funds have been around a lot longer than exchange traded funds, but it was really only in the 90s that you think about the spiders, the SPY, which is an exchange traded fund, which holds essentially a weighted average of the S&P 500 index, allows you to buy and trade an index in one full swoop. Those really are more recent innovations in our industry. And so people may have these single stocks. So we think about the risk of just having a lot of money concentrated in a few different investments. And I'll also probably throw in the caveat, a lot of money that's poured in and being held in a few different investments that is not hedged. And so the traditional way of asset allocation says, hey, if you've got one stock, your expected standard deviation or the variance, meaning how much volatility will your portfolio experience if you just hold one single stock, it's going to be quite a bit. And then if you sort of go up, there's a point of diminishing returns, but I think it's somewhere, 22, 25 different stocks, different sectors, industries, different types of things. You sort of reach the law of diminishing returns, but you have 25 stocks, much more diversified, of course, than just having one stock, where anything that happens, any type of news, any type of bad news can really hurt the company's chances. And there's also something to be said of, let's say you have a very low cost basis and it used to be a growth stock and it was having nice year-over-year growth, and you reach a point where you say, well, I'd probably be better off switching to some, not only diversifying, but switching to something else that has a little better prospects. But we'll get to this, but the tax consequences sort of hold people back. And so thinking about the risk of general asset allocation, certainly everybody, I think, would understand single stock, few different companies, much greater risk than a well-diversified portfolio. Although again, in 2008, everything goes down. And so I mentioned the tax consequences. One of the things that is a real challenge for people, even when they know they should be diversified more. Somebody worked at a company for many years and then they say, I've got all this stock, maybe it's $1 million, $2 million, maybe it's more of the shares of my, call it XYZ company. I don't think XYZ is a real company yet. If a company ever takes that ticker symbol, I'll have to change and use something else. But I've got all this XYZ stock and it's such a low cost basis. I know I should diversify. I know I should lighten the risk on this one and start investing in different types of things. But if I do that, I'm going to have to pay capital gains on all of these shares. And so it's kind of like, well, I could sell it, but I'm going to take this huge tax hit. And the fact that I have to give up so much of the gain, doesn't that essentially mean, if you have to pay whatever it is, 15, 20%, whatever the capital gains amount, depending upon your situation, don't you automatically have a hedge? I mean, yes and no. Single stocks can go down quite a bit. So just the idea of, well, if I sold it, I have to pay the tax, doesn't necessarily hedge you in the traditional sense. But I get it. Individual investors are very shy of selling something with a very low cost basis. And by cost basis, I just mean what you acquire the asset is. So if you buy a stock at 1 and now it's 50, well, your basis is 1, and then you sell it at 50, you owe, in a taxable account, you owe capital gains on the difference. And so that's why we say cost basis is what we're talking about. But yeah, certainly a lot of people, so there's some people say, look, I just want to stay in this one company. I believe in the company. I don't want to invest in anything else. And they believe in it so much, and there's sort of an answer there. And the other is, hey, I know I'm taking a lot of risk by being so concentrated. I'd like to sell, but I don't want to because I've got to pay, have a big tax bill that will come due. And so, couple things or solutions for people in these types of situations. And let's think about, generally I've talked about the whole buy and hedge strategy that I employ, and that's where you essentially get long, meaning you buy the market or something that replicates notionally the market, and you want to capture about 75% of the upside, but you want to put a floor in the downside. And when you say a floor, it's the idea of you put a hedge in, a hedge meaning something that goes up when your underlying investment goes down, so it offsets a good amount of the downside. But generally, when we talk about hedging, we're putting a floor, limiting the downside on an investment. And so, we've talked about buying the market, but here's the interesting thing. Even if, let's say you had XYZ stock and you had millions of dollars in XYZ stock, and it could be quite substantial depending upon somebody's situation, we have the ability to actually go in and hedge directly, as long as the issue has options on it, to use options to hedge that position. And so there's a couple interesting things that happen, a couple benefits. Number one is this has the ability to limit the downside. Potentially, we could sell other volatility or sell other options around it using the stock as collateral. So that's a way to potentially generate income. And the benefit there is that all of a sudden you are hedging what is the most risky thing, and that's a single stock, a single concentrated holding. And so the ability to hedge the downside becomes quite interesting. Now, another interesting thing is, now you might say, okay, well, what if the stock keeps going up and up? Well, great. You took a little bit of money and allocated it for hedging because you don't want to see something that has single stock risk go down quite a bit and erode that account or the multiple accounts holding somebody's concentrated wealth in. But the other interesting thing is when you have hedges on, a good example is, let's say a single stock goes down 40% and you don't feel most of the downside because you've got hedges on. Well, we like to do something called monetizing the hedges, meaning taking the profits from a hedge or the avoided loss, and then using those profits to diversify into a strategy or investments that aren't that single stock. And so even though, you want the stock to go up and up and up, right? The idea is if you do have a move down, the ability to monetize the hedges and then use that money to diversify using the hedging profits becomes very interesting. Now, a couple of things, sometimes people say, well, I don't have a single stock. I've got a collection or I've got a portfolio and I've got, all this stuff in the portfolio, but my whole portfolio has a low cost basis. And you might say, well, it might get a little bit messy having all these different issues and then hedging directly with those. It depends on the options market. But another thing that can be done is this idea of a portfolio hedge. And so without going into the academic part of this, getting into betas and correlation and variance, the S&P 500 is thought of as the market by a lot of people. It's essentially 500 or a little bit more than 500 securities. And it's a weighted, market cap weighted index. And the S&P, every stock has what's called a beta. And let's say you have a beta 1.5. Well, if the S&P went up 1, you'd expect the stock with a 1.5 to go up 1.5. And so betas, you can call it beta weighting, but you can kind of look at a portfolio of stocks and see the sensitivity through correlation or beta weighting or other ways to try and gauge what a movement in the S&P 500 index would be relative to a portfolio of stocks, and then using the hedges on the overall market as a proxy for hedging positions on individual stocks within a portfolio. And so there's a lot of different flexibility that options give us with regard to hedging. Now, another thing that the people often ask is, well, what if the options market's not great on my individual stock? One of the things that ETFs, exchange traded funds that have good options markets do is they give us the ability to, let's say, for example, let's say you had a company in a certain industry. There's probably an ETF on that industry, and depending upon the weighting of that company in the ETF, a lot of times we can use in exchange traded funds options as a proxy as well. And so, kind of think about this. There's a lot of benefits to looking at a concentrated portfolio, either a concentrated in a single stock, concentrated into a few, or a portfolio where you say, look, I have very low cost basis, meaning if you sell them, then you're going to have a substantial tax bill. There are ways to hedge the downside, so take away or reduce, hopefully, potentially, right, the downside risk. But the other benefit, like I mentioned, was this idea of using hedges. So if the market does go down on your position, it's the idea of using a hedge or using the profits potentially on a hedge, and then using those to then diversify into something else. And that becomes pretty interesting as well. So, and I'll just say this too, traditional asset allocation, while it certainly is having more securities and securities that don't all act alike and don't have real high correlations to one another, are certainly very beneficial. But as I've talked about before, in 2008, when the market sold off substantially, what was called systematic market risk, where everything went down at once, it really didn't matter what ETF you were in, what sector you were in, what country you were in. And I talked about this in the book, Broken Pie Chart, is everything sort of goes down. And when you need diversification the very most, it might not hold up in a systematic market event. And systematic market events, as we're talking, certainly can even put a drag or put some downside into well-diversified portfolios. So imagine what a systematic market, downside, or some event, some really bad news about the stock that you have a lot of, what potentially that could do to that stock. And by the way, if all your wealth is tied up in one company, that could certainly really hurt your net worth and your ability to sort of grow your assets and maintain the wealth that you've built. And so there's a lot of benefits to looking at hedging concentrated positions as a wealth protection angle. And it's also this idea of how you take a low-cost basis portfolio or an asset and look to diversify out of that. And there's a lot of different things you can do. And then the other thing, just to kind of loop it all together, is when you have stock in an account, sometimes there's ways to use either an overlay, like other volatility selling strategies, or selling calls against the stock itself to generate income versus stock that's already in an account. And so those become very interesting things to look at. And so if you're somebody who has a lot of your own company stock, or you're retired and you've got all these different grants and really low cost basis, or maybe you just bought things a long time ago and you've got really low cost basis, and you're sort of wondering, are there solutions to maybe diversify, get extra income, or hedge the downside? The good news is options are an incredibly flexible tool. And while many people talk about options as, they say, hey, my neighbor did options, and everybody, not many people make money with options. And by the way, they're probably right, because as we always say, most people speculate with options. But options are a tool that can de-risk a portfolio. And so those become very interesting things. All right, well, this is just going to be a short one. We'll come back shortly to do a little bit more potentially on hedging and some other ideas. And with that, I'll leave it there, and we'll talk to you again next week. Take care.